The moment has arrived, and we are beginning Best of Wyckoff 2018, judging the market by its own action. And this is going to be a momentous day for Wycoffians, and there's nobody more excited about the day that we have ahead of us than your moderator, and that's me, Bruce Frazier. And I'm so glad to be here with you, and I'm very excited for the wonderful day that we're going to have, the people that we're going to hear, and so welcome everyone. And for you that are in the Wyckoff Nation, I know that you're very excited, and I know we have some people that are new to Wyckoff, and my only advice to you is that Wyckoff is one of those things that you want to do all the time. And so once you become hooked on Wyckoff, it can become an all-consuming thing, which is a good thing. So we are welcoming to the new people. We're glad to have our friends who have been studying and using Wyckoff for maybe decades and decades, and we're glad you're here. We're going to have a great day. So today is in memory of our wonderful guiding light, Hank Pruden. Dr. Pruden spoke at last year's Best of Wyckoff, and shortly thereafter, in the weeks that followed, Hank passed away. We all miss him dearly, and we dedicate this day to him. As a matter of fact, it was about, I think it was about 9 years ago, Hank sat down with Roman and I, and he said, we're going to do a conference, and the conference is going to be entirely devoted to Wyckoff, and we're going to call it Best of Wyckoff. And so Hank started this wonderful tradition. This is Best of Wyckoff #4, and it's becomes somewhat of a tradition for us to do this. And so let's take a minute to thank our fine sponsors who have made today possible, starting with the organizer, Roman Bogomazov and his wonderful staff, who have put this all together for us at Wyckoff Analytics. And then we have David Weiss's wonderful organization, Weiss on Wyckoff, and we thank David for participating and contributing. And so we have LTG Trading, and we have Wyckoff Stock Market Institute, and then my blog, Wyckoff Power Charting, and we will be talking at length about all of our important sponsors as we go through the day because they are speakers today. Okay, so moving on, we won't spend much time here. I am your host. My name is Bruce Frazier. I think this is the third Best of Wyckoff that I've hosted, and it's a blast for me. I'm glad to be able to do this, and here I get to sit in my office and do this. So this is a wonderful way for us to be able to have a much wider reach to you all, is to be able to do it through this electronic venue. So I won't spend any time on my own past, other than to say that I started studying with Hank 37 years ago and just absolutely fell in love with market analysis as a graduate student. And then Hank mentored me. We did some research projects together. And then in 1987, Hank hired me to teach in the graduate program at Golden Gate University, and I have been teaching many of the technical analysis courses, but my all-time favorite was to teach the Wyckoff method courses with Hank, which we did for 30 years. So just a wonderful experience. And so moving on, the all-important disclaimer, everybody is here today to educate. So this is very much in the notion of education as Hank taught at Golden Gate University. And so everybody that has been selected to be speakers today are really fine educators of the Wyckoff method. And so this is part of what makes this a great day, because we all want to learn from each other, and we want to have these great masterful Wycoffians be able to share their knowledge and experience with us. And so we're very grateful for them being here. And so just keep in mind that this is not, we're not offering investment advice, we're offering education. And so keep that in mind as we go through the day. And then moving on, here is today's schedule. So I have been given 5 minutes to tell you all of these things. And as you know, I can go on and on and on. And I already apologized to David for to take a little bit of his time. So I'll speed up my breakout sessions. And the reason they call those breakout sessions for me, I'm going to be doing 4 of them, is because when I break out, it's very difficult to contain me again. And so the job to be done is, once I break out, is to get me back contained so that we can get to the next speaker. So our day is that we're going to have first David Weiss as our speaker, Finding Springs, which is going to be very exciting. And then we're going to have Todd Butterfield from Wyckoff Stock Market Institute, and he's going to have a wonderful presentation. I cannot wait to hear this. I'm ready to learn a lot about Wyckoff application to cryptocurrencies. This is going to be very interesting for me, and I know for many of you. And then Roman Bogomazov, who is another great educator from Golden Gate University and has been my teaching partner many times, and we still do collaborate on a number of things. And it's just a lot of fun to work with Roman, and he's got a great presentation plan for us. And Gary Fullett is going to give us a talk on looking for trades at the right edge of the chart, which is really going to be, I think, a very exciting presentation. And then finally, Roman and I are going to do a Wyckoff look at the current markets, and we're going to apply Wyckoff principles to interesting markets, interesting stocks, and that will be how we will conclude the day. My breakout sessions are going to all be devoted to point and figure analysis, and just little 5-minute vignettes on concepts or ideas that might help you in your point and figure work. And so they'll be very brief, and hopefully you'll find value in those also. Okay, so moving on, we have Wyckoff Analytics is Roman Bogomazov's great educational organization, and he has he's putting on this great day for us. And so we want to take a minute and just talk about some of his important offerings that are all oriented towards Wyckoff education and mastery. So he has just started his education teaching cycle, which is the Wyckoff trading course. And in that course, we have 16 sessions. And in these sessions, he talks about all of the important aspects of Wyckoff trading, Wyckoff analysis, and it's just a great start, and it's a great review for people that have been doing Wyckoff for a long time. He's already had one session. I believe that session is recorded, and so it's just not too late to sign up and get involved in that great offering for Wyckoff education. And then the advanced course that he does is the Wyckoff Trading Practicum. And this course is really about taking a foundation of Wyckoff knowledge and then building on that and developing it into a mastery trading platform for you. And so then Roman and I collaborate on the Wyckoff market discussions. And they are a weekly series that we do on Wednesdays at 3 o'clock Pacific time. And we cover, rotate through different markets. We always cover the indexes and the main market themes, and then we go into sectors, industry groups, commodities, student charts. Students will submit charts and we'll go over them together. It's a lot of fun. We have a great time. And then finally, please go look at my blog, Wyckoff Power Charting. And Wyckoff Power Charting is at stockcharts.com. And you go to the Stock Charts homepage, and you'll see Wyckoff, or you'll see blogs at the top, and you just drill in from there. A new thing that we're doing is power charting. And power charting is on Stock Charts TV, and it's a 30-minute program every week. It plays initially on Fridays at 12 p.m. Pacific, 3 p.m. Eastern, and then will play after that on a delayed basis through the course of the weekend and into the next week. And so here, the idea is that we look for different ways to scan for stocks to evaluate. Then we select some, go through them together on a Wyckoffian orientation, and we have a great time doing it. We're getting good feedback from our attendees, so we heartily encourage you to attend power charting. Eventually, we're anticipating that there's going to be an on-demand service for Stock Charts TV for the power charting show. And so go, and then also go to the Wyckoff Analytics website. There's a lot of good content there that's available to you. And then also there's some great specials that have been recorded that are available, point and figure analysis, Elliott and Wyckoff. There's just some great educational programs that have been recorded that are available to you either free or on a small chart for a small charge. So anyway, there's a lot going on there. Please have a look. So moving on, let's begin our day with David Weiss, who is our Wyckoff beacon today. He has been with us now 3 times, I believe, at the Best of Wyckoff. He is a favorite. He has been a phenomenal educator of the Wyckoff method for 46 years. And he has been very generous with his knowledge. There is no better tape reader, Wyckoff tape reader, I believe, in the world today. And he has developed some very unique charting tools, which are Wyckoff-centric charting tools, which are designed to help us to do a better job in our analysis. And so you don't want to hear any more from me, because David Weiss is here. He is going to talk about how to find springs, which is very exciting. And David, are you there?
Yes, I'm here.
Oh my gosh, it's so great to have you here. And I want to say one thing, and this is very important, is that I think there's 2 modern day classic books on Wyckoff, and it's Hank's book, The 3 Skills of Top Trading, and Trades About to Happen by David Weiss. And I believe that every Wyckoffian must have a copy of this book in his library. I keep it right here next to my desk, and I look at it all the time. So I just want to say that before you start. And David, we're so glad you're here.
Well, thank you, Bruce. It's a pleasure to be here. First, I just want to say a word about Hank Pruden, since he is memorialized in a way in this conference. I've met Hank several times person to person, several more times over the phone. He's always been very generous to me, and I always thought he was a great Wyckoff practitioner and instructor. He's sorely missed. I don't think there are many people around who knew the Wyckoff method as well as he did. All right, this morning I'm going to talk about springs. Let me bring up a chart. Finding springs. Finding springs, you know, there's lots of people who are trying to develop algorithms and other scans to find springs. And I've always said finding springs just involves drawing a horizontal line across support. Now, not all of those horizontal lines are going to lead to a spring. For example, if one drew a horizontal line over here at the left of this chart, nothing happens. One of the reasons why is springs don't work very well in a downtrend. You notice all of these springs that I've highlighted are in an uptrend, except this one. Of course, this one worked very well, but it led to a top. But by drawing those lines, I can see the reversals, and many times, as you can see, you have secondary tests. This is the only exception to that. You don't have a secondary test here, which always makes trading springs a little more tricky if you're waiting for secondary tests. But they're all over the charts. If I take this same data and look at hourly from this turning point right here, look at this. This is that first up wave generated by a spring on the daily. And now we're looking at hourly data, and look at all of the springs, just drawing lines under support. Now, obviously, we could have drawn some earlier lines and they didn't work, but that was because we were in a downtrend. But here we had the largest down bar in that downtrend, which was enough to stop it. Anyway, all of these situations developed after drawing lines. So I think if one draws support lines on your charts, you inevitably will run into these springs. And the way I envision springs, I think of three different types. One type is created by shortening of the downward thrust. I would say that is the most common type of spring. And because it's the most common, it's the least likely to work because you're in a downtrend. I've drawn a hypothetical 20 exponential moving average on these diagrams. And because the trend is down, the attempt to spring often fails because the trend is dominant and overrides the tendency to reverse upward. A better type spring, obviously, is when the market is moving laterally, and this is not drawn too well, but the moving average begins to flatten. That has a higher degree of probability. But there's another type of spring, and this is particularly for intraday charts, which I do a lot of, intraday trading. And that is that when the market has already turned up and the 20-period exponential moving average is already moving higher as well, and you have a counter trend 1, 2, 3 pattern, or 3 pushes, as some people like to talk about it. 1, 2, 3 down. In Elliott terms, ABC, but I'm not thinking in terms of Elliott wave. I'm looking at this pattern of 1, 2, 3, or 1, 2, 3 like this, and 3 goes under the bottom of 1, and if there's no follow through and there's reversal action, you could go long and put a stop right under the low of 3. Or you could go long on a breakout above the high of wave 2. Either way, obviously, if you do see a reversal bar as it turns up from this spring action, you could buy it without waiting for a breakout above the high of 2. The beauty of this little strategy is that you're buying it again, as always with springs, you're buying it at the risk point, at the danger point where the risk is the least. And of course, if you're buying it in here, you're protecting very close. So there's not much exposure. As I say, these are quite good on intraday charts, and that's where I mostly focus. I don't use this or think about this very much on a daily chart. Some of my former students do. But look, this is a tick bar chart of the S&P E-mini some time ago. You can tell by the price. And the market's in a downtrend. I'm not looking for springs as the trend is going down. That is the 20-period exponential moving average. We do have shortening of the thrust. And what do you think tells us that this spring is going to work? I hope you see it. The clue is the range of this first up bar. Look at the size of that range. That is the largest up bar on this chart since we turned down from the high to the low. That's the clue that says this spring has a higher probability of working. But there are other springs in motion on this chart. Here we have a 1, 2, 3. You could go long as it reverses up, or you could go long on a breakout above the top of wave 2 and put your stop there. The same thing happens here. 1, 2, 3. You see? And then right here, this is the irregular pattern. 1 down, 2 up, 3 goes under the bottom of 1, and up it goes again. So what you've got working for you here is not only the dynamics of the spring, but you've got the impetus from the exponential moving average, from the trend. So both are working in your favor. It's a great short-term trading for the day trader or the scalper to look for trades on tick bar charts particularly, or 2-minute or 3-minute charts. If you get too far out in time or too big a tick bar, you won't see some of these. They'll be lost. All right, let's go on. Here's a 5-minute chart of Tesla. And you can see that if I drawn a line under this low over here, that we had a spring of that low, and this is the spring, and we come back for a secondary test. You see the EMA, 20-period EMA is going up. We have a 1 down, a 2 up, and a 3 down, and it reverses to close nearer the high and almost unchanged. There's not much selling pressure. So as it starts to move up above bar 2 right here, or immediately you can go long and put a stop here. You don't get to trade Tesla with a 50-cent or 60-cent stop very often. And look at the dynamics that day. This is a good $14 right here on this move. And you can use the EMA as your stop point. Just keep adjusting it under the EMA until you see some price action that suggests it's running into trouble. As I say, it's a great strategy for the scalper or the short-term intraday trader. All right. Now there's something else I use to find trades. When I first started looking for trades, one of the things I did is I turned to stockcharts.com. I found that they had scans. I guess they still do. I haven't checked it in some time. But some of those scans were based on candlestick patterns. And one of those candlestick patterns was the engulfing bar. They had a strange definition of engulfing bar. In my opinion, an engulfing bar is one that engulfs the range to the left or more ranges to the left, its highs and their lows. And you see we have a great engulfing bar. And many times these engulfing bars are associated with springs. But I went a step further. I saw lots of these engulfing bars in a spring position, but it didn't really talk to me. So I decided to add another factor to it. Let's look for an engulfing bar followed by inside bars, one or more inside bars. So that's what we have here. Now look at this engulfing bar. Notice that it opened near the high. It sold off to here, to a new low, and it reversed to close near the open and near the high, and on very large volume. That is a great bar there. There's good information there in the interaction between the open and the close, which is not something I always see. But to see the market recover that well is a great sign that we encountered buying down here. Now we've got about 10 or 12 bars that are all inside this bar. Now the question to you is, as you look at these bars, which one is the best to buy on? A lot of people like this bar, or they like right here where we're sort of absorbing against this high. But there's even a better place, and I'm sure some of you see it. Some of my former students are here. I know they already know the answer because I've shown it to them. But this is the clue. Look at this bar right here. You notice that the volume on this bar is almost the same as the volume on this large bar here, but the range on this bar is quite small, and the market closes higher and nearer the high than the low. What's the message there? Hopefully a lot of you know it. It's effort versus reward, or in Wyckoff terms, bag holding. In other words, there's a big effort being made on this bar to go down, and someone's standing there and buying everything that's available. That's a great setup. I'm not showing it today, but if you want to see another example on a monthly chart, look at US Steel in March of '09, which is a very narrow range as it goes to a new low under support. And it's the biggest volume than on the big breakdown bars. It was another situation just like this. All right, let's go on and look at this. I call this OBIB, outside bar, inside bar. And I even created a trade station scan. So every night at the end of the day, I've got a list of stocks that have an engulfing bar followed by one or at least one inside bar. Now, most of those situations are not interesting, but every now and then I find a jewel like this chart in February 2016. All right, now look here. This is a pharmaceutical stock. The symbol is ABC. It's one of my favorite charts also. And you can see how the market broke into new low ground on very heavy volume, closed very badly. It looks like it's death. It's supposed to go down, but instead of going down, it levitates up. It just floats up on low volume. That's very deceptive. It's hard to believe that's really positive. But then here comes the demand. This is a great demand bar. This is the second heaviest volume on an up bar on the whole chart. The biggest volume is on this crazy day here where it closed just fractionally higher. So this is the most bullish bar on the chart, up bar on the chart. And the engulfing bar occurs right here. It's a very tight pattern, by the way. We've got a whole bunch of bars inside that liftoff bar, but here's the OBIB. This is the engulfing bar, engulfing one day, and then we have three inside bars, and then we have another engulfing bar as it turns up with big volume. This is great compression. You can almost draw an apex with this downtrend line connected to here and a line going up. But we really press the market down to a knot. It's about to do something really big, and look what it does. It goes higher for 14 consecutive sessions before it turns down right here. And this is just the beginning of the move. Now, I'm not saying that all of these configurations of outside bars, inside bars are going to produce a move of that magnitude, but they do produce well when they're in the right configuration, when it's the right setup overall on the chart. All right, let's go on. Another place where you find springs is in absorption. And before I go to the absorption, look at the outside bar, inside bars, right? This is a platinum continuation chart. Look here. Look at the volume on this bar. It's engulfing how many days? 1, 2, 3, 4, 5, 6, 7. Looks like at least 7 days, maybe 8. And it's followed by two inside bars. And look at how the volume drops off. And the narrowing of the range and the mid-range close, that puts it dead square on on the springboard. I'm sure Hank Pruden would know what to do with a chart like this, and so would Wyckoff. This is an absolute beauty. And it goes straight up. You see every bar closes higher up until this bar here. Now, how do you know that this is absorption? There are not too many clues except for this spring. Right here, we have a little trading range between this high and this low. And on this bar, there was an effort to take it down. There was even a pickup in volume. And for all that effort, it closed near the high and just slightly lower on the session. And we come back to even test it. So this is definitely absorption. In an absorption area, you like to see persistent pressing against the resistance. You like to see higher supports, which we really don't have here. But what we do have is a very shallow pullback after a steep run-up. And that's a very good sign, indicative of absorption. And then to see that spring and secondary test in the middle of that behavior really tells you we're indeed going to go higher. But not all up thrusts work with springs. This is a Weyerhaeuser, WY, and you see you've broken down, and the market is rallying up to the ice. And look at these thrusts to the ice, and look at the position of the closes. They're telling you when the market closes near the low of the bar, you know it encountered selling. Even if it closed higher, like it did here, we know we encountered selling. But the market came back and gave us a spring of these lows. So we were in position to go up. But look at the lack of follow through. This bar, the fourth from the right, closes on the high, and there's no follow through. And then on the next to last bar, it closes near the high, and there's no upward follow through, and demand is diminishing. So here, as occurs with some other springs in a downtrend, you can see right over here, if I draw on a line here, you had a potential spring and no follow through. It's very typical of a downtrend with springs. All right. And this is what Weyerhaeuser did in just the next few days. So it moved sharply lower. One could have gone short easily on this breakdown bar right here and put your stop above the high of the previous bar. I know a lot of people don't like to sell breakdowns, but this has all the earmarks of a market poised to go lower with the testing of the ice and repeated failings. All right, let's see. Now this is a different situation. I'm using my WeissWave software on a 5-minute S&P E-mini. And the WeissWave is accumulating the volume on the various waves or price swings during the day. And these volumes are in thousands of contracts. I find that this volume is, on average, much better than time-based volume because it gives you a truer picture of the true force of the buying and the selling. If I put the 5-minute volume bars on here, this is at noon, the volume would be quite low normally. But anyway, the clue is here. We have a spring here. First we had a spring in the early morning right here. And look at this liftoff. Look at the vertical price movement. We have 48,000 contracts on that liftoff. So there's great demand and great ease of upward movement. And markets like to test those vertical areas, vertical high volume areas. And we come back in here to test the spring. And on the test of the spring, we have a spring of the first test, which I'll show you another example of. But this doesn't happen all the time. But the clue that the market was going to go up was the diminished volume right here. This is the lowest downward volume on the chart up to this point, right here, 9,000 contracts. It's lower than any of these other downward volumes. And look at the position of the closing bar in that wave. So this, and with the S&P, I always tell students, I look for waves on the 5-minute chart with a 0.75 retrace. I look for waves that are under 10,000. That doesn't mean they're all meaningful, but I should pay attention, or one should pay attention to any wave that has less than 10,000 volume. I mean, this 7,000 volume here, you might say, well, if you're doing this automatically, that's a sign of weak demand and you go short. But no, not after what we've done here with this big spring here and this pullback to test the vertical area and so on. And then you see how the volume dries up again. And we have a little minor spring right here. This might be called a 1, 2, 3 up thrust in motion. Anyway. And then we dry up here where we're testing this volume right here. All right, let's go on to the next chart. This is Citigroup. This is an hourly chart. When you put hourly volume on a stock chart, or a futures chart for that matter, what do you see with the hourly volume? What you see is the pattern of volume, the pattern of trading activity during the day. Most of the time, the largest activity is in the first hour. You can see it. All of these big volume surges are the first hour. And then you see how it dwindles down. It's hard to find any useful volume information from the hourly chart, but when you look at the wave volume and you see how the market lifted off here, and we pull back to test that vertical area, vertical high volume area, we've just gotten into the upper edge of that area, but look at the wave volume. We come down on 6.1 million, 2.9 million, and then 2.5. So the selling pressure is diminishing. You can't tell that from this volume. All you see here is the pattern of volume. And then look at the volume here, 4.1 million. That's the heaviest volume since the high was made several days ago. So, and great liftoff bar, great reversal. And then there's pretty big effort to take it down, 3.7 million. And it doesn't, it only corrects a little of it. And so we take off. And here there's a total lack of supply. If you didn't buy it here or in here, you could still add here where it goes up on 12.9 million. All right, let's go on. I would normally ask you, are there any questions? One of my other favorite strategies is to look again for these vertical areas. This is a monthly chart of the US dollar index. And you see I painted green. These are not the biggest volumes, but that's the vertical area of the chart. And you see how you came back into that area and tested it. You rallied and you came back again and you have a spring of that area. I love to see springs occur on tests of breakdowns, just like the one we saw before on the 5-minute chart. And notice after that how tight it got, how the range is narrowed. The inside bar here with the mid-range close and generally low volume. It's a great sign that we're on the springboard. And my favorite, of course, is I like to see springs on a pullback to test a major breakout. This is the Apple monthly chart. This appears on charts of all time frames, but you see how the market came down in 2015 on top of the breakout that occurred in 2014. And Apple did rally a little bit, but then in early 2016, we came back to test, and ultimately we had a spring of the 2015 low. And again, look at the inside bar, the narrow range, how tight it's gotten here on that spring. This is a tremendous situation right here. And if you look at the Apple monthly in the past, you can see many of these examples where it made highs and then backed up later to test them and had springs. But it happens on all charts of all time periods. All right, let's go on. Okay, this is what's
David,
known as, yeah?
Are you, would you, I do have a question here if you.
Okay, all right, what's your question?
Sure. It is asked, do you always suggest a 20 EMA?
Well, yeah, that's what I use for looking for the springs in motion. I do, yes.
Okay, Terrific. And everyone, if you do have questions, I'll try to monitor them. And as the opportunity arises with the speaker, I'll
Yeah, I
put
don't
them
mind
in.
you interrupting me and asking me any questions. You know,
Yeah,
I'm usually doing mentoring sessions and it's a back and forth. It's not a lecture where I just talk nonstop. So
yeah. So keep the
I'm much
questions
more
coming.
comfortable.
Yep.
I'm much more comfortable giving and taking.
Wonderful. Okay. Well, I will keep monitoring this and looking for questions, and then I'll keep my mic open
All right.
so that I can jump in if it's appropriate.
Okay.
So please continue.
All right.
Thank you.
Okay, this is a mean Renko chart. TradeStation allows one to make a mean Renko chart. I think NinjaTrader does too. Lots of platforms will. And I'm very fond of these charts. Renko charts are noted for filtering out data. Renko charts are like wave charts. They're not based on time. In other words, a brick can last, these are called bricks, and a brick can last a second or it can last several hours. This is a 2-point brick, so that means that the colored portion of this brick is 2 points. And with the mean Renko chart, when it forms an up break like here, if it makes a tick above the high of that, it immediately indents halfway back and then it builds back up or it reverses down like it did here. And I have a custom indicator which I put a little dot that shows when the wick on the brick is equal to the brick size. That's the maximum movement. So with the 2-point brick and a maximum wick, you can have 4 points. But here, and then I also place the wave volume and the minutes. It's very useful to do that. And right away, looking at the wave volume, you can see the Weiss wave volume. You can see that this is 218,000. This down wave, the next one is 42,000, and the next one is only 16,000. So you can tell that the force of the selling is drying up. If you don't have the Weiss wave to put on these charts, TradeStation is not going to tell you, and neither will NinjaTrader. All right, but look at the brick volume and the action in this brick. This is what's so interesting. These are the kind of clues that one can derive from Renko charts. This chart, let me get my note. This chart, I wrote down how many minutes it is. This last, hold on. This last chart, I'm going to give you the precise data. The minutes of that last brick there with the blue arrow, it's 15 minutes, and the volume is 33,000. Well, compare that to the previous downwave. The previous downwave was only 9 minutes, and it was 16,000. So we have more volume, and thus more time, in this break than we did on the last downwave. And I find that to be a significant clue. There's lots of information from the combinations of volume on these with these breaks, and of course with the wave volume. Together, it's pretty powerful. And you can see this is a 24-minute up wave. The reason that it stopped here, of course, is we came back into this brick right here where we had 77,000 contracts in 76 minutes right there. So that's where supply overcame demand on the way down. And we rallied back into that area. And that's a logical place for the market to stall and meet resistance, because people who were long up here and didn't get out now have a chance to liquidate and get some of their money back. People who bought here are taking profits, and new shorts might be coming in. So the market pulls back some, but there's no supply. I find these charts most fascinating. I'm even contemplating a book on the subject. All right, let's go on.
We would heartily encourage that.
Well, I'm
Um,
trying. Any
um,
questions?
not that we want to make, not that we want to make work for you, but that sounds really good. Um, yes, there are a couple of questions.
All right.
There's a question on up thrusts. Do up thrusts also work on the same principles?
You mean up thrust in motion, 1, 2, 3, going down, or you mean
Well,
just reading up thrust
I'm believing that this is an up thrust is sort of an
on a
the
bar, just a
counter
regular on a bar chart?
on a
Yeah,
bar chart.
it's basically the same, but up thrusts are not tested quite as often as a spring. I'm trying to go back and see. Uh, well, like over here, this is the hourly Citigroup chart. But
Mm-hmm.
if you drew a line across this high where we had 30 million on this big up wave over a day and a half, you can see we went above it. And when we went above it, the wave volume diminished 3.8 million and then 2.0. So you can tell from this wave volume that the force of the buying is drying up. So that's a good clue. And then the next up wave is only 1.3. That's the lowest up to that point on the chart. So this is a minor up thrust that provided this pullback. But yeah, you can use the same things. You pay attention to the range, you pay attention to the volume, you pay attention to the position of the closes of the bars, all the things that I talk about already. Up thrusts are often faster. That's all. Here on this monthly dollar chart, well, when you're looking at monthly charts, you've got a line across this high, and you see you break out and you don't have any follow through. You erase all of it and you try to go up and there's no ease of movement and it starts pressing down. So that's a good clue that it's going to fail. We didn't have any follow through after this breakout. We had ample opportunity to go up.
How about that big bar there right after the up thrust where it closes on the low?
Right.
It's a
Right
wide
there.
bar.
Yeah. It's the widest down bar certainly since way over here.
So it's sort of
2015.
the converse to the spring
Right.
bar.
Right. Exactly.
Mm-hmm.
Yeah. This
Okay.
doesn't look like a sign of strength. It looks more like a sign of weakness.
Yeah. Interesting.
Yeah.
Well,
Yeah.
question now going back to Renko is could David please describe the way a mean Renko bar differs from traditional Renko?
All right. The traditional is called the classic. The classic doesn't have a wick, first of all. All right. So if you were doing this without the wick, you wouldn't know that prices traded under that low during the formation of that brick. So that's one of the drawbacks of the classic style Renko chart. Uh, Now, one of the nice features of the classic is that the distance from high to high to high, if you were doing 2-point bricks, is 2 points. When you're doing a mean Renko, because you indent automatically, you're only making 1 point higher. Therefore, you have more bricks in this progression than you would with the classic. So it makes for a tighter chart. But I think personally, the very best chart is probably a classic Renko with wicks. I didn't prepare one. Someone made for me a custom indicator that were plot wicks on a classic Renko in TradeStation, but TradeStation doesn't provide the wicks, and a lot of platforms don't. But there are websites where you can purchase classic Renko charts with Wix as an app that you can put into your, like MT4 has it, I know. They do that. MetaTrader 4. Any other questions?
Well, those are
All right.
yes. Thank you very. And there's many thank yous for
Okay.
yeah. And
Right.
there's going to be more questions, I'm sure. So
Yeah. All right.
don't let
Well,
me take you off your
yeah.
path.
Don't get me confused.
I doubt that
I get lost quick.
Well,
I'm doing an exercise here that I show to my students, and usually it's a back and forth, but I'm showing an unnamed, well, I'll tell you the name of it. I think this is Micron Technology, MU, and I'm showing a daily chart with a potential spring in it. And you know, it's very easy to draw a line across this low over here and say, look how we closed under that support in a very bearish position and there was no follow through and we had a spring. That's nice and easy. But when you look at it in real time with all the ambiguity, all the things that look like it's good and look like it's not so good, the things that change your mind. I always tell people the biggest cost in trading is not the cost of the hardware or the data or the software, your special software you buy. It's the finding out expense. It's being willing to find out, is this spring going to work? Or maybe I should get out. I don't like the look of that bar. It went up here and it closed in the middle. I don't think it's going to work. I better get out. Or maybe I should raise my stop or whatever goes through one's mind. So instead of finding out, we abort and it springs, lo and behold. But there are times when one should not wait any further. One shouldn't wait to find out any further. The evidence is too overwhelming, high probability that it's not going to work. So the question here with this stock is we've broken into new low ground on that daily bar next to last, and you see the volume is the heaviest in probably 12 or 15 days. We close a little bit off the low. We close even with the line of support that we penetrated. So it's a potential. That's the way they say it in the Wyckoff lexicon. It's a potential spring, and I say it too. And now on the next bar, we've got a little narrow range inside bar. I guess we're coming towards Christmas, but this is a little early yet. But anyway, do we want to buy this or do we want to wait? We're going to get 6 bars here. I'm going to show it in 6 frames as it develops. You can tell me you want to buy it right now and put your stop under the low of the next to last bar, or you can say you want to wait and see more and go long later, or not go long at all, or go short. These are the things I tell my students as we watch this chart unfold. So I can't ask you that. I can't get a consensus of who wants to do what. So let's assume that you buy it and you put a stop under the low of the previous day. It's a low risk bet. It's a cheap stock. Unless you're doing 10,000 or 20,000 shares, this isn't going to add up to very much money. All right. So how do you like it now? If you didn't buy it, would you want to buy it? Are you sorry you missed it? You can still buy it. It's relatively cheap. Those who bought it, I guess, would stay long. It doesn't go up on much volume. Are you worried about that low volume? Does that worry you? There are lots of things to worry you. We can draw a downtrend line. This will worry you. Draw a downtrend from here across here. And we were bumping up against that downtrend line. And we got low volume and narrow range. Do we like it still? We can make a case for everything here. Our mind is a wonderful thing. All right. Now, what do you think? Ooh, what do you think about this? Is this going to work? Let me see. I know what happens. I'm just trying to keep up with my. All right. Now, this might make you want to get out. This is an engulfing bar, right? This bar engulfs the ranges of the previous 2 bars, closes on the low, and it's the heaviest volume in 3 days. Would you stay long? Well, for our purposes, we're going to stay long. We're going to keep our stop here. We think it's a low enough risk. It's not not a nice feeling. All right. Now let's see what happens. What do you think of that bar? Would you stay long now? Or you sad that you got out? Would you go back in? You think it should be rebought? You're missing it? Again, these are all the things that our mind tells us. Now what do you think? What's the clue? We're going to get the answer on the next chart. What's the clue of what it's going to do? Does anybody see it? Anybody want to venture an opinion?
Well,
Bruce?
I'll try.
All right.
I'll channel what everybody's thinking. No,
All right.
no. I I see the 2 bars ago is that big down bar,
Yeah.
which goes down to the close,
Mm-hmm.
is on high volume, but it doesn't make a new low, and the volume is not as high as on the spring bar.
Right.
So I
That's
would
good.
take a little comfort in that.
Right.
And so I'm always worried, so I'm just trying to find comfort.
Well, we all are.
And then the current bar is another big wide-ranging bar, closes on the lows, but the volume is diminishing, and it is another higher low. And so which makes me,
Now you said something.
yeah, that
Higher low.
makes me think that the supply might be drying up.
Right.
So I would take a little comfort in that.
All right. So you'd stay long.
I'm staying long because you told me to.
Okay, good. That's good enough for me.
I'm listening. I'm taking notes.
All right. All right. Well, Bruce really touched on something. You notice that we're making higher highs and higher lows. What is that called? That's called an uptrend.
Yeah.
And notice that after the third bar back, we closed on the low and there was no follow through. That's a good sign. So, I mean, anything can happen. You remember Mark Douglas's book where he said we're working in a probabilistic, the book is Trading in the Zone. We're working in a probabilistic environment. And in that environment, first of all, anything can happen. And secondly, no one knows what's going to happen. And we have to live with that. That's what comes with the territory of trading the markets. And a lot of people would get out here. I know they would. They say, this is enough. Watch. Is that nice? Aren't you glad you're along? The spring worked. Okay,
I closed out my position.
Oh, look at you. You're trading too quick. You're not
No,
letting the market tell you to get out.
I'm just,
I know.
I just feel better.
Well, I mean, but if we trade to feel good, we're in trouble.
Uh-oh.
We don't feel good that often.
No, we don't.
That's what leads to cutting short profits short and letting losers ride. You know, people hang on to losers because every day is the day it goes your way. They hold on to, they cut those winners short because they're going to lose their profit. Anyway, you know what I'm saying.
Yeah.
All right, now this is a new one. This is Apache, 2000. No, wait a minute, I did the wrong way here. Hold on. This is 2005, one of my favorite charts. This is Apache. Now I'm sure that Bruce knows the answer to this chart as soon as he looks at it. So Bruce, don't say anything.
Okay.
But what's he going to do? Does anything stand out? Does anything catch your eye? Would you buy it? These are the questions you have to ask. Well, since I'm doing the talk, can you get a consensus of the room? How many of them want to buy it? How many of them want to sell it?
So everybody make a vote, long or short, and let's just see if we can get a kind of a consensus, just long or short. It looks like it's mostly long.
Well, that's interesting.
Yeah, mostly long.
Right.
Yeah, maybe a
There
third short.
All right. You only had 3 shorts?
I'd say a third of the people.
Oh, a third.
Third of the voters were short.
All right. Well, 2/3 want to go long. So let's go long with the majority. And why would you go long here? There's a real good story here. A real good story here. Look at the volume in the last bar and look at the range. What do they tell you? You have more volume on both the next to last and the last bar individually than you do on the third bar back. On the third bar back, you have great ease of downward movement, a weak close, and very large volume. On the next bar, you have even more volume and the range narrows, but you close on the low. So I wouldn't buy it. It closes on the low. But I'm thinking there's a lot of effort here and not much reward. And that is personified by the last bar. Look at that range. It closes in the middle. Why isn't it going down? The reason it's not going down under all that pressure is someone is standing there and buying. That's what it means, bag holding, to quote Mr. Wyckoff. That's what's happening here. We have bag holding. This is a great place to go long. I'm not saying you put your stop right under the low of that bar. You might get nicked. So maybe you put it at 25 cents under that low. But this is a place to go long, at the danger point, where the risk is the smallest. Now, look at the next bar. Aren't you glad you bought it? Isn't that a nice bar? How many of you want to take your profit? This is not going to be that easy. But here we have a nice jump. We go through both levels of support. We close nearer the high, but we close off the high. And we have the biggest volume since we broke down on this bar. A lot of people would say, I've made $1. I might just take this money. I know a lot of them would.
Now, David, I have a question.
Yeah.
In Wyckoff with springs, they often talk about when there's a high volume spring that to expect a test.
Right.
And so anyway, I just put that out there for you. I don't know how you approach tests of springs.
Well, I'm willing to buy it before the test because I don't know that we're always going to get a test, particularly with intraday charts, which is where I operate mostly. With daily charts, there's more of a tendency, but not 100% for a secondary test. But yeah, secondary tests are wonderful, and that's the ideal. But I trade the S&P a lot, and it's a cloud of dust and a hidey-hi-ho when it wants to spring.
Okay.
It doesn't give everybody a chance to pack their bags and get aboard.
That's really interesting because there is a lot of discussion about springs, types of springs, tests of springs, and so on. So that's an interesting.
Well, in the Wyckoff course, they teach spring number 1, number 2 spring, number 3 spring.
Right.
And number 1 spring is where it's a Roman candle, where the guy opens his parachute and it doesn't open; it goes straight down. Number 2 is where ideally you come back on low volume and give you a secondary test with a narrow range, low volume. But I've seen it come back and test on more volume than the spring because there's still a lot of effort, no reward.
Yeah.
And then what they used to do when they taught the Wyckoff course, I remember Dave Mathis would say, this is a 2.5 spring. That means it's coming back on heavy volume on a secondary test, a number 2 spring, rather than low volume. So he called it a 2.5. Anyway, on and on.
Yeah.
Watch what happens. So we're going to stay long here. We got nice ease of movement. But now look, market has come all the way back down to the low, but it closes mid-range. Now this is the ideal low volume secondary test of a spring. Right. It's not as narrow as you'd like, but the volume really dries up and you close mid-range, so you know there was buying at lower levels. So that really puts us on the springboard, right? Would you agree?
I would agree. Yes.
All right.
A low volume, higher low, so on.
Yeah, it's pretty classic. All right. So look what happens. Now what do you think? Now we've got a question. Now we've got some ambiguity, right? We got the market gapping up and testing that vertical high volume breakdown bar and coming up into this congestion right here. We might call that ice. another layer, and we close back near the low. And the volume is not enormous, but it's bigger than the day before. That's a potentially bearish bar. Who would get out here? Who would stay long here? These are the things. You now got you've got $1.50 made, maybe $1.75. That's not bad. That's car fare home. All right, watch.
So some people are getting out.
Yeah, I know.
Yeah.
But I look at this chart and I wouldn't get out for the world.
Mm-hmm.
This is a beautiful looking chart. I mean, look at the selling climax over here and the big rally and all of this testing, and then the spring of this on a secondary test of that, creating another spring. I think it's really squared off. I think there's a big base here. It's going to go a lot higher. Now look at what it does. Those people who hopped off, what do you see here? What's bullish about this bar? The most bullish thing about this bar is the higher support and the position of the close. And there's no serious selling pressure. But the higher support and the position of the close tell you we are poised to go up. If you're not long, you better buy the close of this bar, because look, here we go. And up, I'm sorry. And up we go. And that's just the beginning of it. This one went a lot higher. Look it up if you want to. It's Apache in 2005, just after January. Okay.
Where's your stop on that trade?
Well, the first stop, as I said, I'd put maybe 25 cents underneath that low. Okay. After the rally up here, I think I'd keep the stop there. Mm-hmm. But after this bar, I'd lower my stop to just a little under that springboard position.
Now, David, I often see markets go up on diminishing volume.
Right.
And after the completion of a base accumulation. And so I just put that out there for you because I often hear from people that they're confused by a market going up on diminishing volume.
I can tell you what it means.
Yeah, that's what we want.
That means there's a lack of supply.
Ah.
You go up on low volume because there's a lack of supply. These are the formulas for interpreting volume, that markets have to have increased volume on up bars to be bullish. That's erroneous. And you have to have increased volume on down bars to keep going lower. You can go lower and lower because there's no demand.
Yeah.
So that's why. So
once absorption has been largely completed, then there's not a lot of stock to be bought. And so it doesn't take much volume effort to propel prices higher.
Right. The only selling you're getting is longs taking profits.
Yeah. So I think that's a really important point. So I just.
Oh, it is. Yeah. Well, I didn't bring it up. I'm glad you did. But
I'm just trying to read your mind. I'm not doing a very good job, but.
No, you're doing all right.
Okay.
Okay.
Anyway.
I mean, you can look over, right?
No, go ahead, please.
How much time do we have?
I was just checking on that. You have about 12 more minutes. So
well, I'll get through that early. All right, we got one more study. The next one is the third one.
These are terrific.
I got a bunch of these that I show students. All right, this is a stock that I like to watch because it mirrors a commodity. It's SLV that follows the silver market. It has a lot of gaps because it's responding to what silver does overnight. But silver trades 24 hours, or most of 24 hours. All right, and so the market has come down here and found a little support and rallied, and we've come back down to this low. Now, that's a low risk buy, that's for sure. I mean, we've got a $2 scale. I mean, if you bought it right here at maybe 31 and maybe 30 3/4, you could risk 80 cents or call it $1. It's not much. We're not in December here. The volume's very low. Does this appeal to you? Does this look like it could work? Well, it might be a place to make the bet. You can notice that I do have my engulfing bar followed by an inside bar. I noticed that after I put this chart here. I didn't create that on purpose. So you see this bar engulfed the ranges of, I think, at least one bar, maybe two. And then we have an inside bar and there's no volume. All right. So let's see what it does. So we jump up. That looks pretty good. Maybe we didn't buy it. Now let's assume we didn't buy it. Now it's jumped up. It's closed above the highs of the previous 5 bars, filled most of the gap. There's no big increase in volume, but it's a good bar. Maybe we could say there's no supply. We're breaking the downtrend line that we could draw off this high and this high. Or at least we're coming close to breaking it. We're right up against it, I guess. Let's see what kind of follow through we get. Now, what do you think of this? We totally erase that up bar. We go below the close of 2 bars back. Volume doesn't tell us much. The increase in volume is minimal. So we're mostly looking at price movement. Volume doesn't help us. So do we want to buy this? I don't know. I don't like it yet. Watch. Now, we have one of those little narrow range bars, no willingness to follow through on the downside, very low volume, unchanged, mid-range close. Looking at that, I could see why one would go long and make the bet and put the stop directly under the low. I could see doing that. Watch. Oh, I went the wrong way. I gave you too many of them here. All right, so we've got a couple more bars. What do you think here? And I don't know how I skipped, but anyway, would you stay long? If you own this stock, would you stay long? How many people want to be long?
Who wants to be long here? Go ahead and vote. Long or short? Buy now, long, some longs.
All right.
Mostly longs, a
Yeah.
few shorts, mostly longs.
I can understand some difficulty, but what's the problem with this chart? I wrote about it in my book. I described this behavior. It might have been this chart, I don't remember. But the problem with this chart is that we're hugging the lows. We've had ample opportunities to go up, and we didn't go anywhere. We had this big bar where we jumped above 5 bars, and it was totally erased. Then over here, the 4th bar from the right, we closed near the high, and we had no follow-through. And then on the next to last bar, we tried to go up. We closed near the low, but we did close higher, but no follow-through. Now you can say, well, we're making slightly higher lows, but I don't like this. As I say, it's hugging the lows. It's not a good sign. And what I would do if I wanted to buy this potential spring is wait for a breakout above that high. If it does go back above that high, I'd buy it on a stop and put my stop loss order right underneath this low, or wherever it is, wherever the last low is before it broke that high. But look what it does. It breaks down and it goes lower.
David, one thing that stands out about that chart to me is that it's in a downtrend.
That's right. And look at this ugly bar over here.
Yeah.
That's worth a wad of peanut butter.
Yeah. And there's a climactic surge right before it too. So climax and then a big breakdown.
Yeah, right.
Yeah, sign of weakness.
Yeah, it's not a warm and fuzzy chart.
Because you had said right from the beginning that you want to do springs and uptrends.
Yes.
So I don't know, how you would define a downtrend here, but this is like nearly 2 months long.
I know.
So.
Well, it's not accelerating down. It does accelerate from this point, but not a huge amount. Maybe down $1 or $2, a couple of dollars. All right, well, those are all the charts I have. If there are
Well,
any
let's see if
questions,
there's any questions
let me
here.
show you. Let me show you all my products here.
Come on, yeah,
Uh,
let's see what you got.
I
Honestly,
do.
people, if you're a Wycoffian and you enjoyed this analysis today, Trade's About to Happen and is a must-have book. I just read it over and over. I just look at the
Well, thank you.
charts. It's wonderful.
Well, I've gotten lots of nice compliments. But anyway, I have this Riceway plug-in. It costs $500. It works on TradeStation, NinjaTrader 7 and 8, MetaTrader 4, and Metastock. Uh, I also have a 4 DVD set of a presentation I made. It's one of the best presentations I ever made. It costs $139, if I remember correctly. The book is $39. Uh, and I do a lot of mentoring. Uh, and you can contact me if you're interested. You can contact me at weissonwyckoff.com if you have any questions about things I talked about today. Um,
So here's a great question. How do I become a student of Weiss? Does he offer classes every so often? So
I'm doing classes every day. I have a number of students who I'm mentoring. It consists of 12 one-hour sessions held over Skype where I share my screen uh, and I can see the student's screen too if he wants to, or she wants to show it to me. Uh, I deal with reading bar charts, bar by bar chart reading, wave by wave chart reading. We discuss springs, upthrust, tests of breakouts, breakdowns, absorption. If you have Renko charts with your platform, I go into the world of Renko and show you a lot of my tricks. Um, I talk about point and figure charts. Um, NinjaTrader has a nice feature. If you have the Weiss wave, it'll put the wave volume numbers on the point and figure chart, which goes nicely with the columns on the point and figure. Anyway,
we have very little time left, a couple minutes, but there is a question. Many thank yous. People are just glowing about your presentation.
thank you. It's my pleasure.
Oh my gosh. And uh, uh, the question here is, what is your preferred platform or the one that you use?
I use
So I don't know if
TradeStation. These charts you saw are
okay.
all made from TradeStation.
Okay.
I don't know that it's the best platform. It has its own problems. They all do. I understand NinjaTrader 8 is pretty good. I'm impressed with MetaTrader 4, and I've been a Metastock user for a long time, but I don't use it on an end-of-day basis. I like Metastock particularly because you can get quarterly and yearly charts, and you can go back many years. With Ninja, they have a wonderful feature, a playback feature, which TradeStation doesn't have. In other words, you can work on the weekend and go back to a certain point in time and unfold the chart bar by bar at your own speed. If you have the Weiss wave on there, then you can see the wave volume build as it goes up and down. It's a good learning tool.
Well, David, thank you so much.
My
And
pleasure.
it's always just a joy to have you present, and we greatly appreciate your Wycoffian generosity. So
Thank you.
I think that's one of the great aspects of Richard D. Wyckoff is that he so much wanted to educate
And
people
so did
on,
Hank Pruden.
and so did Hank Pruden, and I think that's true of the entire Wyckoff community.
Right.
And it's one of the things I really love, and you totally personify that. So,
Well, thank you.
and so,
Go on.
no, please.
I was just going to say, I remember when I first started, and the man who introduced me to the Wyckoff course, uh, and when he talked about the Wyckoff course, he did it in hushed tones. He didn't want anyone to even hear the word. He didn't want people to know the secret that so few knew at that time in 1971. Um, If he were alive today, he'd be very unhappy that I wrote this book, Trade's About to Happen, because I'm showing all the secrets of the Wyckoff course. But I think it should be shared. And he did share it with me.
Well, and I believe that we're not really a large community,
No,
and I believe that there's room for all of us. So
right.
yeah, well, I'm glad you wrote that book. I'm glad you're here today, and we look forward to more of these.
All
So
right.
can you hear everybody standing up and they're applauding and
All right. Thank
all
you
right,
very much
David.
for coming. Thank you very
Thank
much.
thank you.
All right. Take
So
care.
long. Bye,
So
David.
long. Bye-bye.
Wow. Well, that was, I know we didn't get to some of your questions. You can get a hold of David. And David, I want you to know that there are many people that are saying applause, great presentation, thank you. David is simply the best. It's all true. And what a wonderful citizen of the Wyckoff community. So anyway, now we have breakout session number 1, and these are very short, and this is going to be all oriented towards point and figure, which is something that David does a lot of, and we have to have him back sometime to talk about point and figure. But this is this particular lesson or breakout is just on the principle of how to take account. And so there are specific rules for how to take horizontal counts in Wyckoff. Wyckoff is somewhat different from other methods. We know point and figure, many people use the vertical method, which is terrific. And so vertical can be quite useful. We use horizontal. We do horizontal counting based on the vertical bar chart. So we do our analysis on the vertical bar chart, and then we take the points that we are analyzing as being significant on the vertical bar chart. We put them onto the point and figure chart and then take counts. So in this particular case, we are looking at crude oil. So this is a continuous contract of light crude oil, and I actually have done a number of blogs on crude oil because, well, they're great case studies. Crude oil works really, really well with point and figure, and so it's you can see here a wonderful accumulation, a structure that goes back all the way into, you could say, into the end of 2014. Here we are in 2018, so this is a very large structure. And because we are doing this breakout in a very short period of time, I'm going to get right to the heart of it because I could talk about this chart for a long time, is that we look for the completion of accumulation. So in this case, we're seeking out some evidence of strength. So here we can see a sign of strength, and it's a minor. Let's go over to the minor sign of strength. And we call it a minor sign of strength really only in the regard that it's still inside of the accumulation range. But you'll notice an attempt to go up, and it takes out the 2 prior peaks, and then hangs out up there, becomes very dull and quiet. It doesn't have the ability to follow through from there, which puts us in the expectation that there's going to be an attempt to come back down again. After a minor sign of strength, we have, using a non-Wyckoff term, our spidey sense to expect a pullback to a last point of support. And a last point of support or a spring. There's 2 ways you can have the final test of the bottom of an accumulation range. It either can be a spring type action or an LPS type action. So after a sign of strength, we would look for a last point of support, which is the final low that takes place in the accumulation range prior to the rally up and out. You can have more than one last point of support, but at this point, we can see this is phase C. Phase C is the final testing area before you are up and out. So we take our count. So we go over to the point and figure chart. We identify the area of the minor sign of strength and the last point of support, and we count from that place. We start at the right, we count to the left. That's the way we do point and figure. You can see I color-coded 2 segments to count. So the red segment is the smaller. These are places where supply comes in. You can see that there's big bouts of supply that show up, and these are identify the separation of the segments. And then there's a third segment here, which I didn't count, but identified additional segment to the selling climax. So the rule is you count from the last point of support over to the selling climax. And if you have segments, you count those. So we have a segment here that goes to the red segment, and this count generates 23 columns of count. And this is a 3-box reversal, 23 boxes, 23 columns of count times 23 times 3-box reversal, times the scaling. We use standard scaling here, traditional scaling, and that which under $100 is 1 point scaling. 23 times 3 times 1, 69. And then we add that to 2 places. We add it to our count line, which is where the line where we took the count. You can see there the horizontal line, and from the low. And we add that 69 to those 2 places, and we get a count of 96 to 115. Seems pretty far away from here, but notice now this chart's was generated at the end of the first quarter, end of March. You can go back and update this, but this chart is now up and out. It's jumped out of the accumulation area and then backed up. A backup is just another term for another last point of support. And you can see that labeled on the vertical chart, LPS. So there's 2 LPSs that we can count from. And we may extend our count out. We're always willing to adjust our counts. We may actually at some later date include the backup or the LPS at the top of the range out further into a larger count. And so, but what we're really interested in is we're interested in the potential that exists inside of this accumulation area. And so the second count extends, the second segment extends out to this large sort of climactic area where it goes down early in the accumulation, 49 columns. So 49 times 3 times 1, 147 points of count, which we add to the count line and to the low, and that takes us 174, 193. So we can see that there's a lot of potential in the accumulation of crude oil, and what we would like to see is that crude oil remains out of the accumulation area and doesn't try to come back into it again, which would be a very bullish sign. And so we're, right around $70 right now. So we're, starting to work our way away from the accumulation area. So hard to imagine at this point, but this is why we do horizontal counting, is that we have these large counts, huge potential. This is a campaign potential opportunity in crude oil that really the point and figure analysis really illustrates how much potential does exist in this idea. And so we will continue to watch this, but this case study is really about how to take counts. And I encourage you, you can actually go back and look at this blog and take the bigger count. And so, and then also consider taking the count from the backup over all the way across also, just as a case study analysis. But we need to get, we have 2 counts directly ahead of us, and those are the counts that we would be considering for trading purposes or for campaign purposes. So anyway, that's our first breakout. And so we will at this point move on because you don't want to hear me, you want to hear our next speaker. And so